The invisible market war, how algorithms control price, and how smart traders adapt. The trade that should have worked. Have you ever taken a trade that looked perfect? The setup was clean. The level was respected multiple times. Indicators aligned. Risk management was solid. You entered with confidence, and within seconds, price moved directly into your stop loss. Then something strange happened. The market reversed, moved exactly in your predicted direction. But without you, that moment feels personal. Almost as if the market knew your position before you even clicked the button. Most traders brush this off as bad luck, but after it happens repeatedly, you start asking deeper questions. Because modern financial markets are no longer shaped primarily by human traders. They are influenced, accelerated, and sometimes dominated by automated execution systems operating faster than human perception. Today, we're going to uncover how these systems interact with liquidity, why price often moves in ways that feel manipulative, and more importantly, how traders can adjust their thinking to operate alongside these forces instead of fighting them. The market is not a battlefield. IT is an ecosystem. Retail traders often imagine markets as a simple competition between buyers and sellers. But the real structure is far more complex. Modern markets operate like ecosystems with multiple participants, including institutional asset managers, market makers, quantitative funds, algorithmic execution firms, retail traders. Each group has different objectives. Retail traders typically seek directional profit. Institutions often prioritize order, execution, efficiency. Market makers focus on providing liquidity while maintaining balanced exposure. And algorithmic systems specialize in speed and efficiency of execution. Understanding this structure changes everything, because many price movements are not designed to predict future direction. They are designed to manage liquidity. Why liquidity is the real driver of price. Large institutions cannot simply buy or sell massive positions instantly. If a fund attempts to purchase billions of dollars in assets at once, it would push price aggressively against itself. Instead, institutions need counterparties willing to take the opposite side. This is where liquidity becomes critical. Liquidity represents clusters of pending buy and sell orders. These clusters frequently form around predictable locations, support and resistance levels, previous highs and lows, round psychological price numbers, breakout zones. Retail traders naturally place protective stops around these areas, not because they are wrong, but because trading education universally teaches the same structural concepts. And when large numbers of traders place orders at identical levels, those zones become liquidity reservoirs. How automated execution systems interact with liquidity. Algorithmic execution models are designed to locate areas where order flow is concentrated. Their objective is not necessarily to target individual traders, but to access large pools of available orders. When price approaches heavily populated zones, several things can occur. Execution algorithms may accelerate price movement toward those areas. Once price reaches these levels, triggered stop orders and breakout entries release significant liquidity into the market. This liquidity allows institutional participants to efficiently build or exit positions. After liquidity is absorbed, price often stabilizes or reverses. This sequence can create the illusion of targeted stop-loss hunting. In reality, it reflects the mechanical process of institutional order execution. Why speed is not the retail trader's advantage. Algorithmic trading firms invest heavily in infrastructure designed to reduce execution latency. Some systems operate with response times measured in microseconds. For individual traders, competing directly on speed is unrealistic. But speed is not the only dimension of market participation. Automated systems are extremely efficient at reacting to predefined conditions. However, they lack contextual interpretation beyond programmed logic. This creates a structural limitation. Algorithms excel at immediate reaction. Humans excel at adaptive interpretation. And that difference creates opportunities. The power of observing market reactions instead of attempting to predict initial price movement. Professional traders often focus on observing market reaction after major events occur. When price breaks through key levels, experienced traders analyze whether momentum sustains beyond the breakout, whether price quickly rejects the level, whether volume increases or fades. False breakouts frequently leave visual signatures. These include long rejection wicks or rapid reversals after level breaches. Such behavior can indicate liquidity absorption rather than genuine directional conviction. Waiting for confirmation after these events often produces higher probability trade environments. Seeing beyond price charts. Price charts display the outcome of transactions, not the underlying order flow driving those transactions. Professional traders often incorporate additional tools that reveal market participation dynamics. Volume distribution analysis can highlight price levels where significant trading activity occurred. These zones frequently act as reference points for future market reactions. Order flow visualization tools display real-time transaction imbalance between buyers and sellers. Sudden surges in transaction volume at specific levels can reveal aggressive institutional activity. These insights allow traders to evaluate market intention rather than relying solely on price movement. The role of patience in modern trading. One of the most underestimated advantages retail traders possess is time flexibility. Algorithmic execution models are designed to respond instantly to changing liquidity conditions. Human traders can observe, interpret, and delay participation until market conditions clarify. Many high-quality trade opportunities develop after volatility events subside. Waiting for stabilization allows traders to confirm directional conviction, identify logical stop placement, improve risk-to-reward rate. Patience transforms reaction-based trading into observation-based trading. Market volatility and information shocks economic announcements and macroeconomic events, introduce unpredictable variables into market behavior, while automated systems process numerical data rapidly. Interpreting the broader implications of new information often requires human judgment. Major economic releases frequently trigger extreme volatility spikes. During these periods, liquidity temporarily disappears. Price swings become exaggerated. Automated models may generate conflicting responses. Once volatility stabilizes, markets often realign with the deeper economic implications of the event. Observing post-event stabilization can provide valuable directional clarity. Risk management, the true survival edge. Regardless of trading methodology, risk management remains the primary determinant of long-term survival. Professional traders focused heavily on position sizing and exposure control. No analysis method guarantees accuracy on every trade. Losses are unavoidable components of probabilistic trading systems. Successful traders measure performance through statistical consistency over large sample sizes. Managing downside exposure ensures that trading capital survives inevitable losing periods. Aligning with market structure, retail traders often attempt to outmaneuver institutional participants. A more effective approach involves understanding how institutional behavior influences price movement. Instead of entering trades during chaotic liquidity sweeps, traders can focus on identifying areas where institutional activity likely occurred. These areas often provide structured environments where price reactions become more predictable. This approach shifts trading from reactive speculation toward strategic observation. Conclusion: trading is adaptation, not competition. Financial markets have evolved dramatically with the integration of automated execution systems. Attempting to defeat technological speed directly is unrealistic, but markets remain driven by liquidity needs, risk transfer, and participant behavior. Understanding these forces allows traders to operate alongside market structure rather than opposing it. Successful trading is rarely about predicting every movement. It is about recognizing recurring behavioral patterns within a probabilistic framework. Traders who adapt to market structure improve consistency and reduce emotional decision-making. Because ultimately, markets reward preparation, patience, and risk discipline far more than speed. A different way to see the market. If you've ever felt frustrated watching price move against you, it might not mean your analysis was wrong. It may mean you were participating during phases where liquidity was being redistributed. Learning to recognize these phases changes how you approach every trade. Because the goal is not to chase price movement. The goal is to understand why price moves the way it does.